Usually, when you look at a financial dashboard during a major market crash, there's this expectation of just, well, absolute uniformity.
Right, a sea of red.
Exactly. It's not just a few red numbers here and there. It's a synchronized waterfall. I mean, it's like watching an airplane fly straight into a massive downdraft. The macroeconomic environment just pushes everything down at once, and the panic, it becomes completely contagious.
Yeah, contagion absolutely takes over. And when that happens, the underlying mechanics of individual projects, they simply stop mattering to the average market participant.
Yeah, fundamentals go out the window.
Pretty much, the herd mentality sets in, and the primary objective just becomes liquidating assets as quickly as possible,
Yeah.
regardless of what the actual structural health of the asset is.
So today on the deep dive, we are taking the sources you shared with us and really extracting a masterclass in how certain microeconomies actually survive those exact market crashes.
It's a fascinating case study.
It really is. We are unpacking a highly detailed short-term report from day 183, so that is March 31st, 2026, of an experimental DeFi, or decentralized finance protocol, called PLZM.
Right.
And the mission today for you, the listener, is to look at the math, block out the market noise, and figure out how a tiny ecosystem engineered its own internal, thermal updraft while the rest of the market was basically in a free fall.
But before we open up the engine room to see how those mechanics actually work, we really must set the parameters based on the source material we are reviewing today.
Very important, yes.
This deep dive is purely for educational and entertainment purposes. PLZM is an experimental high-risk DeFi protocol.
Yes, super high risk.
Exactly. So nothing discussed today is financial advice. You must always do your own research, as all invested capital could be entirely lost.
Right. So let's start by painting a picture of that broader macroeconomic storm that was raging on day 183. Because to really understand the anomaly of PLAZM, you have to understand the gravity of the downdraft it was flying through.
The context is everything here.
Yeah. The crypto market basically woke up bleeding. Ethereum dropped 1.61%, sliding down to $2,024.14. And slipping below that 2,100 psychological barrier, well, that triggers a lot of automated selling.
It absolutely does.
And Bitcoin was following the exact same trajectory, dropping 1.76% down to $66,277.
But the price action is really just a symptom, right? The psychological metric is the actual disease on a day like this.
Oh, for sure.
If you look at the crypto fear and greed index for that day, it was sitting at an abysmal 11 out of 100.
11. That's incredibly low.
It firmly places the market in extreme fear territory. A reading of 11 means the average market participant is more terrified right now than they have been in about 89% of historical market conditions.
Wow.
Yeah. Rational analysis is largely abandoned in favor of just pure capital preservation. People just want cash.
So we have a market drowning in extreme fear. But here is the data point that defies the gravity of that whole downdraft. Despite the entire market bleeding out, on day 183, PLZM was actually up 1.47%, sitting at $0.0177.
Yep.
And the companion token in their ecosystem, eShare, it remained relatively flat, dipping just a tiny fraction of a percent to $7.50.
And running the comparative math on that gives us the real story. That 1.47% gain, it actually represents a 3.08% outperformance versus Ethereum on a heavily red day.
That is massive.
Okay.
But here's where the pushback has to happen. If you look at how PLAZM is built, its underlying treasury, it's vaulted, it actually holds Ethereum.
Correct.
So logically, if the vault holds an asset that is actively dropping in value, PLAZM should theoretically be dragged down right alongside it. So I have to ask, is a 3% outperformance just a statistical fluke, or is it what the report labels a bullish decoupling?
Well, a random spike on a red day can easily just be a fluke, right? It could be driven by a single large buyer coming in at the right time.
Yeah, a whale just splashing around.
Exactly. But true decoupling is structural. It requires genuine buyer demand generated from within the ecosystem itself, entirely divorced from the sentiment-driven speculation of the broader market.
Okay, so how do we know which one this is?
To determine if PLAZM's decoupling is truly structural, we have to look past the surface price and actually examine the internal mechanics of its vault.
Okay, let's go into that engine room then. The report details the contents of the PLAZM vault for day 183. It holds 204.5 ETH, which was valued at roughly $413,915. But the report also documents that the vault balance actually dropped. It went down by about 4 ETH from the previous day.
Right, and the report explicitly notes this drop is a feature, not a bug. It is the protocol operating exactly as intended.
Okay, but if the vault is bleeding for ETH to pay out yield to its users, that looks like a leak in the ship to me. I mean, the report simultaneously states the bond APR, the annual percentage rate users earn, actually increased from 37.06% to 38.4%, even as price of Ethereum declined.
It sounds counterintuitive, I know.
It really does.
Yeah.
Let's walk through this, because to me, it's like a business that somehow magically increases its profit margins, even when the cost of its core materials drops, and its cash register literally has less money in it. How on earth does the APR go up if the vault is technically holding less ETH?
Let's break down a micro example of how those compounding bonds actually work to achieve that mathematical feat, that 4 ETH. It didn't just vanish due to a market loss.
Right.
It was distributed to users as yield. But those users didn't take that ETH, run to the open market, and sell it. They took their payouts and actively compounded their positions by purchasing more bonds.
Oh, I see. So the capital never really leaves the ecosystem.
Exactly. It shifts from the liquid vault to the bonded treasury. The total number of bonds stands at 12,345. That's an increase of 22 bonds just on this single day of extreme fear.
Wow, even in a panic, they're reinvesting.
Yeah. When a user bonds their tokens, they lock that value into the protocol to earn a higher share of future yield. Those bonds represent 17.67% of all PLAZM shares. Furthermore, the protocol utilizes a feature called buy and grow.
Buy and grow, what does that do?
It automatically contributes 2.6 bonds per day, derived entirely from internal yield.
Wait, automatically, meaning the treasury is structurally programmed to grow its bonded positions even if literally zero new human participants join the protocol.
That's the beauty of it. The internal economy is actively self-sustaining. But the real mechanism driving the APR higher while ETH falls, it comes down to a vital structural dynamic: the ratio of the vault's capital to the token's market capitalization.
Okay, lay the numbers on me.
Well, the vault holds roughly $413,000 worth of capital, but the total market cap of all PLAZM tokens combined is only about $189,000.
Wait, let me make sure I'm hearing that right. The protocol actually holds more than double the amount of wealth in its vault than the total combined value of every token in existence.
Yes.
It's massively over-collateralized.
Yeah, massively. When you have a $413,000 engine pushing a $189,000 vehicle, the relative power is immense. Because the protocol's total market cap dropped slightly along with the broader Ethereum market, the relative yield power of that massive vault actually increases per token.
Ah, the ratio shifts in the token's favor.
Exactly. That massive capital buffer smoothly absorbs the macroeconomic shock and mathematically drives the APR up for the bonded holders.
Okay, so having a massive yield-generating engine is great, but we still need to explain how that yield translates into the green price action we saw on the charts. Like, how does the protocol weaponize its yield to create actual buying pressure?
Right, the real-world impact.
Yeah. Looking at the daily metrics, day 183 generated a protocol yield of $425.58, and the report emphasizes that this is real USDC stablecoin generated from a, quote, DEXFI bond strategy. Wait, pause right there. DEXFI bond strategy sounds like a total textbook buzzword. Before we talk about how much yield it makes, let's define what that actually is for the listener. Are we talking about traditional corporate debt here?
Not at all. In traditional finance, a bond is debt you lend money to a company and they pay you back with interest. In this ecosystem, DEXFI stands for Decentralized Exchange Finance.
Okay.
It means the protocol takes the capital in its vault and deploys it across decentralized exchanges to act as liquidity. When regular users out there trade or swap tokens on those exchanges, they pay trading fees.
Right, standard exchange fees.
And the PLAZM protocol captures a percentage of those trading fees as a liquidity provider.
Ah, so it's acting like a toll booth. It's earning actual revenue from people making regular trades out in the broader crypto ecosystem.
Precisely. And that revenue is paid out in USDC, which is a stable coin pegged to the US dollar. That distinction is what separates PLAZM from the vast majority of DeFi projects out there.
Because most of them just inflate, right?
Exactly. In most projects, quote-unquote yield is just code for heavily inflating the token supply. They print new tokens out of thin air to pay users, which just dilutes everyone's value and eventually crashes the price. PLAZM is generating actual tangible profit from active capital deployment, not from printing tokens.
Okay, so it earns this real yield, then it takes that tangible profit and runs to the open market. There's an automated function called buy and burn.
Yep, my favorite part.
Over its lifetime, this function has spent $72,180. Just today, it spent $290 of that generated yield. It buys PLAVM from the open market and permanently destroys it. I mean, it's exactly like a publicly traded company aggressively doing stock buybacks with its daily cash register revenues, permanently shrinking the number of shares available.
And alongside buy and burn, there is the buy and build function. This has deployed $28,370 in its lifetime, adding roughly $50 today.
And what does buy and build do differently?
Well, instead of burning the purchased tokens, buy and build pairs them with liquidity to thicken the trading depth. So the protocol is simultaneously shrinking the circulating supply while making the trading environment much more stable.
That's clever. The report also highlights an active buy pool reserve sitting there with $1,940 in USDC, essentially acting as an automated wall of buying ammunition.
Yeah, a buffer.
But I have a major mathematical problem with this entire system.
Okay, let's hear it.
The report lists claimed profits, meaning the money users have successfully extracted from the protocol to put in their own pockets, right?
Correct.
The cumulative lifetime total for claimed profits is over $119,000, and it went up by almost $380 today alone. If the daily yield is $435 and users are claiming $380 a day in profits, well, a $1,940 buy pool should vanish by Friday. The constant sell pressure should completely overwhelm the system. How is this considered a healthy report?
That's a really valid point. If all those tokens were highly liquid and everyone decided to sell at exactly the same time, a $1,940 buy pool would indeed be vaporized in seconds.
Exactly.
But you can't just look at the cash register to stress test a microeconomy. You have to look at the circulating supply map. We have to determine where every single token is actually located right now to see if a massive dump is even mathematically possible.
All right, let's pull up the supply breakdown then. The total supply of PLAZM is 10.71 million tokens, valued at that $189,420 market cap. Here is where they're sitting. 19% of all tokens, so about 2.45 million, are permanently burned, gone forever. Another 17%, which is 2.3 million tokens, are staked in 77-day lockup cycles.
Right.
15%, or 2 million, are locked in liquidity pools, leaving 49%, about 6.42 million tokens, as actually liquid and circulating.
And we saw a slight rotation in those numbers on day 183. The stake supply dropped by 1%, while the liquid supply rose by 1%.
Yeah, the report notes that rotation happened because today was an epoch payout day. For the listener, an epoch payout is essentially a scheduled dividend distribution. The protocol distributed $1,560 in real yield across roughly 88,500 staked tokens.
So real yield landed in real wallets.
On a day when the rest of crypto was completely terrified. But let's look at this supply breakdown. It's like an exclusive concert venue that has a maximum capacity of 10,000 tickets.
Right. Okay, I like this analogy.
1,900 tickets have already been thrown in an incinerator. Another 1,700 are locked in a time delay save for 2.5 months. Another 1,500 are held by the venue as collateral. So almost half the tickets literally cannot be sold by anyone today, no matter how panicked they get.
It creates artificial structural scarcity. And those 1,500 tickets held by the venue, the 15% in liquidity pools, those are critical. A liquidity pool is simply a smart contract where users lock their tokens alongside a paired asset like USDC or Ethereum to facilitate trading for others.
Right, they provide the depth.
Yes. And they earn fees for providing that service, but those tokens are removed from the immediate dumpable supply.
Okay, but that still leaves the 49% liquid supply.
Yeah.
And it ticked up by 1% today. Even with the burn tokens and the lock tokens, 49% is still a massive chunk of supply. What stops those liquid holders from just dumping their tokens, taking their real yield, and ruining the party?
They absolutely can sell. Rotation and profit-taking are normal parts of any protocol cycle. But to understand why that selling doesn't crush the price, we have to look at the scale of the battlefield. The key takeaway from the supply picture isn't that no one will ever sell, it's the absolute lack of new inflation shocks.
Meaning the system isn't constantly printing new tokens to water down the price.
Exactly.
The report highlights a metric called the release radar, which tracks upcoming token unlocks. Over the next 7 days, only 22 tokens will be released. That's worth about 39 cents. And there are 0 major emission cliffs for the next 80 days. The report literally calls it clear skies.
Think of inflation in crypto like trying to empty a swimming pool with a small bucket while someone else is actively filling it with an industrial fire hose.
Yeah, you're never going to win that.
Right. In most inflationary projects, the internal buybacks the bucket can never keep up with the new tokens being minted and dumped on the market by the fire hose.
But with PLAZM, the fire hose is turned completely off for the next 80 days.
Yes. 80 days of practically 0 new tokens hitting the market.
That's I mean, in crypto time, 80 days is an absolute eternity.
It really is. So the daily yield of $435 only has to absorb the natural, sporadic selling of existing participants. It doesn't have to fight a tidal wave of newly printed supply.
That makes a lot of sense.
When you combine this deeply structural scarcity with a vault that is massively over-collateralized compared to the token's market cap, the protocol can easily absorb a 1% rotation without the price collapsing. The buy and burn mechanism is highly effective because it operates in an environment of fixed or shrinking supply.
And this is ultimately what secures the report's final verdict of healthy for day 183.
Precisely.
Let's zoom out and recap the mechanics we've just unpacked, because this is a blueprint for structural resilience. We started with the macro environment, Bitcoin and Ethereum dropping. The fear and greed index sitting at an abysmal 11 out of 100.
Extreme fear.
Right. Then we zoomed in on PLAZM and saw a highly unusual 3.08% outperformance against Ethereum. We opened up the engine room and found a massive $413,000 vault generating real USDC revenue through decentralized exchange fees, driving a 38.4% APR.
Which is incredible on a down day.
And finally, we saw how that internally generated revenue is used to systematically buy and burn a token supply that is strictly limited, with zero major inflation events on the horizon for 80 days.
The real insight for you, the listener, goes far beyond the specifics of this single protocol. Whether you trade crypto, invest in traditional stocks, or evaluate business models, the underlying lesson is really about value creation.
Yeah, it's universal.
The aha moment of this report is that scarcity alone does not create value. A fixed supply is meaningless if there is no demand. But when you combine structural scarcity with automated, non-inflationary revenue generation, you create an economic engine that can resist macro market panic.
It's self-sustaining.
Right. The protocol didn't survive the downdraft because of good marketing. It survived because the math of its buy pressure literally outweighed the panic of the market.
Scarcity combined with automated, non-inflationary revenue. That is the formula. It's a powerful reminder to always look past the prevailing market sentiment, past the sea of red on the charts, and do the math on the underlying systems.
Absolutely.
But analyzing this survival mechanism leaves me with one final provocative thought for you to mull over. We just spent this entire deep dive mapping out how an engineered internal economy survives and actually climbs on a day of extreme fear.
Yeah.
What on earth happens to a protocol with built-in continuous buying pressure and zero inflation when the broader market inevitably flips back to extreme greed?
When the downdraft turns into a tailwind, an over-collateralized engine with a shrinking supply map creates a highly explosive scenario.
That is a market condition we will definitely have to track. Thank you for joining us on this deep dive into the mechanics of decentralized resilience. We'll catch you on the next one.